For most of modern history, if you wanted to find the source of a financial crisis, you looked in one place: the government. From Latin America in the 80s to Europe after 2010, the logic was simple. If governments were solvent, the system would survive. If not, it wouldn't. All eyes were on sovereign debt. That world is gone. The biggest financial vulnerability of our time isn't hiding in one single balance sheet. It's distributed across three: corporations, governments, and households. For the first time, each one is carrying a historic amount of debt. Each is exposed to the same cycle of rising interest rates. And they're all connected through taxes, wages, credit, and asset prices. Stress no longer creeps slowly from one sector to another. It transmits instantly. This is what we call the debt triad, a new, unstable system where a problem in one area immediately becomes a problem for everyone. So, how did we get here? This didn't happen overnight. It was a slow burn across three distinct eras. First, we had the sovereign era. In the late 20th century, global finance was all about government borrowing. Countries financed their development with debt. When a crisis hit Mexico or Brazil, it was a story about states. Then, things shifted. The 90s and 2000s brought us the banking and household era. Deregulation and fancy new financial products moved the leverage directly into our homes and banks. The 2008 crisis wasn't a government collapse. It was the implosion of household debt, magnified by a fragile global banking system. And that brings us to today, the era of total leverage. After 2008, central banks kept interest rates near zero for over a decade. It was like a global debt party. Governments borrowed to keep their economies afloat. Corporations borrowed to buy back their own stock. And as asset prices recovered, households started borrowing again. When the pandemic hit, the response was universal. Everyone, everywhere, expanded their balance sheets at the same time. This is where history quietly broke. For the first time ever, all three pillars of the economy became leveraged to the hilt, all at once, on a global scale. Now you might be thinking, what's the big deal? In the past, if one sector got into trouble, another could step in to help. If households were paying down debt, governments could spend more. If governments tightened their belts, corporations could invest. But today, that option is gone. There's no clean substitute left. Corporate debt is now as big as sovereign debt in many places. Public debt has reached levels we once only saw during world wars. And household borrowing is still structurally high, thanks to the soaring costs of housing, education, and just living. The most dangerous part: all three sectors now have to roll over their old, cheap debt in a new world where capital is much more expensive. There is no longer a low-leverage sector left to absorb the shock. What makes this even riskier is that our financial world is completely interconnected. Global asset managers hold a mix of corporate bonds, government bonds, and mortgages from all over the world. Your pension fund links your savings directly to corporate credit. A vast, unregulated shadow banking system connects leveraged loans to insurance portfolios. So what happens when things go wrong? It's a chain reaction. Stress in the corporate world can trigger capital flight from a country. The capital flight makes it harder and more expensive for the government to borrow. The government's financial strain then squeezes household incomes through higher taxes or cuts in services. And when households are weak, they spend less, pay fewer taxes, and are more likely to default on their loans, which feeds right back into political instability. The system no longer breaks at one single point. It buckles across the entire network. This debt triad looks a little different depending on where you are in the world, but the stress is shared globally. The United States sits at the heart of the corporate debt pillar. American companies went on a borrowing spree over the last decade. U.S. households look okay on the surface, but their wealth is propped up by inflated housing and stock market values. And the government. It has made massive debt a permanent feature of its economic management. Europe, on the other hand, carries the heaviest government debt overhang. Aging populations and rigid economies leave public finances incredibly exposed to higher interest rates. China represents a mirror image of the West. Their household debt exploded through a massive real estate bubble. Corporate debt grew through state-directed projects, and a huge amount of public debt is hidden off balance sheet. In China, these three pillars are not just connected, they're structurally fused together. And what about emerging markets? They sit at the intersection of all three pillars, but with an added fragility. Currency. Their companies borrow in dollars. Their governments depend on foreign financing, and their people absorb global inflation directly through a loss of purchasing power. When global financial conditions tighten, emerging markets get squeezed from all sides at once. Different epicenters, but the same architecture of risks. This is why the old crisis labels were used too, like corporate downturn, sovereign debt crisis, or consumer recession. Just don't cut it anymore. Each one only captures a symptom, not the underlying structure. We aren't living through a sequence of separate debt problems. We are in a structural phase of synchronized leverage, where everyone has to refinance their debt at the same time in a high-rate world. This combination, at this scale, has almost no historical precedent. This is the new architecture of global financial risk, and it's why we're using the Debt Triad as our guide. Each pillar now governs a critical part of our lives. Corporate leverage determines job security and the value of our retirement accounts. Sovereign leverage dictates government flexibility and geopolitical power. Household leverage shapes consumer spending, housing stability, and political outcomes. Each pillar feeds the others, and none can stabilize the system alone. Over this series, we're going to trace how this new system of stress transmission works. Part 1 will dive into global corporate debt, the most sensitive pillar, where refinancing risks and market reactions hit first. Then, we'll turn to sovereign debt, where sheer scale meets politics. After that, we'll focus on household leverage, where economic pressure becomes social and political. But a system doesn't crack everywhere at once. Stress always emerges where the sensitivity is highest. That starting point is corporate debt. In a world where companies everywhere borrowed cheaply for a decade, the global repricing of capital is now a massive pressure test. This is where our journey begins. Thank you for watching. Make sure to subscribe so you don't miss Part 1, the Global Corporate Debt Conundrum.